Welcome to Investors Insights. Our topic today is market recovery handoff. I thoroughly enjoyed our meeting this morning, and in this market environment that continues to show strength, we've got clients asking the question over and over again, can this market go higher? There's paranoia out there. We're seeing prices go up in homes and copper and in other commodities. Concerns are out there. But I think you're going to find some very valuable information in this vlog today. My colleagues, Bobby Norman, Trey Booth, and Adam Van Zandt have done some incredible research, and we want to share it with you this morning. So with that, Adam, Trey, and Bobby, I tell you what, let's start off with Trey, because Trey, you really emphasized this market recovery or market strength, and is it a handoff to see future growth in the market? Talk about that.
Yeah, definitely. So on Friday, we got the most disappointing jobs number in history of tracking the
Yes,
U.S. jobs market. From a standpoint of disappointment, 266,000 jobs were created month over month. That is a really good number. In context, it is very disappointing compared to the over 1 million jobs that were expected by economists across the board. And so that was very fascinating to see such a large miss. But what was more interesting, it was the market reaction to the news. Now, initially, the market reacted negatively, but throughout the day, the market actually rallied. And what does that tell us? That tells us that currently we are still in recovery mode, not in expansion mode for the U.S. economy and the stock market. So when the market rallies on bad news, that tells us that the market is improving on the idea of more or sustained stimulus from the federal government and more low rates and stimulus from the Treasury and the Federal Reserve. And so when you see bad news as good news, that's indicative that we're still in the recovery phase. The next phase, where you have expansion, you go from recovery to expansion, that's really where you get the long-term legs of the economy. That's driven by increased profits, increased GDP, increased earnings, which then drives the market higher. This report also showed indications of that, because if you look under the hood, productivity was actually up 5.4%. So, what does that mean? That means that per worker, we're getting more production. And how is that possible? Because we're sitting here right now, 8 million jobs shy of where we were pre-pandemic. That being said, the GDP, the gross domestic product, is roughly where we started. So we are very much more productive per worker than we were before. And why is that good? That's very positive, because if we close that 8 million worker gap, then the gross domestic product or the economy will be that much stronger. So we actually see a 5.4% increase in productivity per worker. And a lot of the unemployment is in the leisure and hospitality. We saw 331,000 jobs in leisure and hospitality created last month alone. We're still over 3 million jobs short of where we were before the pandemic. And why is that important? Because leisure and hospitality is a quick recovery jobs, because there's less training involved, there's less increased capital expenditure, and so that's a gap that we should be able to close quickly in the summer months where you see a lot of leisure and hospitality spending. So while the initial jobs report was very negative, the market reacted because we're still in recovery. We still have very positive stimulus from the federal government, very positive stimulus from the Federal Reserve. On top of that, we're seeing individuals being more productive, and that should lead to, down the road, once we get all these jobs back, that should lead to much, much higher earnings, which can push the market higher past recovery, past stimulus, into an expansion.
And I thought that was great insight, Trey, especially with all the paranoia that's out there as we've seen strength in the market. But we still have a ways to go, and I think your data helps explain why we're seeing that strength and also why the strength can continue. So that was excellent insight. And then Adam, you talked about we've hit record highs from a technical analysis standpoint. Talk about that in relation to the information Trey just provided us.
I appreciate it, Greg. So yeah, to your point, the S&P on Friday closed at 4,232. That gives us a new resistance level of 4,260 with a new support level of 4,200. One thing I also want to talk about as well is you heard Trey elaborate a little bit on being in a recovery phase. One thing that we look at that's evidence to support this claim is typically moving day averages. We usually typically talk about the 50-day moving average of the S&P. I want to talk about the 100-day moving average. We saw that push over 3,900 currently sitting at 3,919.
Yes.
The reason that's important is that could start to become one of our long-term either support or recovery levels moving forward in the markets.
And that's a great point to check off on, to give people confidence to understand the strength that's in this market. And then I also like the dynamics of our meeting this morning because, Bobby, you jumped in and said, with our clients, as we discuss portfolios and they ask for proof or evidence that, hey, who else feels this way about it? You brought up about corporate dividends and what took place last year and what's going on this year. Talk about that.
Yeah, I want to give an update on corporate dividends. Remember, dividends are an important part of owning stocks because that's money in your pocket. And when a company pays dividends, it's expected that it will keep that dividend going. It basically is a commitment from the company. But last April, in the pandemic, we saw over 24 companies in the S&P 500 reduce or suspend their dividend, with more cutting dividends throughout the year. But here's the great news. The great news is that this April, the opposite happened. Last month, we saw 33 companies in the S&P 500 announce dividend increases and none announced decreases or suspensions. So, estimates are for dividend payout of the S&P 500 will increase 5% this year, which will mean a payout to investors above $500 billion in corporate dividends this year. But here, the bottom line is this. A year ago, companies had no idea what was going on and what to expect. Now there's much more clarity and we're willing to put their money where their mouth is. So with interest rates still being historically low, corporate dividends continue to be a bright spot and benefit in owning stocks. It's something we're continuing to watch.
No, I think you're absolutely right. And, when people see what they're getting on their money market rates and the CDs and what they can find in government and corporate bonds, to see dividend yields like that with quality stocks over a long period. Yes, they do fluctuate, but they also paying out those dividends. That's very attractive to investors. So we hope you've gotten a lot of information and insight today to have a better understanding of what's going on in the markets so that when you have the TV on, when you're on the internet and there's doom and gloom and concern and caution, understand this. We're going to continue to manage our clients' money in relation to their financial blueprints. We want to keep them on track in relation to those blueprints. The markets will have volatility, but the strength we're seeing today is recovery strength that we like, and we think it's going to be with us for a while. We think there's some good things ahead of us, and our crystal ball, like everybody else, you can't predict the future, but we do believe this data that we've shared with you today helps give a better understanding of why the market has reached new highs and why it has the potential to go higher. Follow us on social media. Several of you are great about forwarding our vlogs, our Facebook, our Twitter, our LinkedIn. And I also need to emphasize, just listen to our episode on the podcast. A lot of our clients tell us that they're doing that as they're walking and running or even driving their car. As Trey said in his comments going into the summer months about leisure and entertainment, we hope you're able to plan a trip, do more things, the vaccinations are working, and that we're seeing a positive recovery in this country. Have a great week.